Good day, fellow investors. Bank stocks and insurance stocks look cheap at the moment, but the fact is that those look cheap always. Let's discuss why I decided that in my life I will not become a bank and insurance investing specialist. And this is also a video that I will put as an answer always, because I usually get these comments: Sven, what do you think about Citi? What do you think about this bank, about this insurer? The P ratios are always low, the dividend yields are always good. So what is wrong? The cash flows look great, everything looks great. Why aren't those a buy? Because yes, Citi is trading at below tangible book value. Will answers that it usually does because they are a low quality bank. They do a lot of subprime stuff, and that risk is reflected in the stock price. But Warren Buffett bought, and there is always some restructuring plan that will turn them around and make good investments. That's always the story with banks and insurers. And a lot of you are interested in investing in banks, insurers, especially as Warren Buffett is the specialist on investing in banks and insurance. And here, if we look at Citi, also Morningstar is looking at it. Last close is 53, the fair value 78, so big company, what can go wrong, right? And the stock price should be a bargain because, of course, 80 is the target. But if I look at this is the chart of Citi, and now it is at 10% of where it was in 2007. And if I remember correctly, I remember looking at this somewhere here, and the price-earnings ratio, maybe here, I don't know, the price-earnings ratio was still in the single digits. So that is investing in banking. And when it comes to investing, I really would love to avoid these things in my portfolio. Yes, it can rebound, but if I avoid this over the long term, I will do well. So this is one reason. But Sven, Warren is investing now, so if Warren is investing and buying these lows, why aren't you? I'll first discuss another example, and then we'll dig into Warren Buffett's bank and insurance investing strategy. Another company that I get questions often is Aegon, the European US insurer. And if you look at the stock, if you look at the fundamentals, it's again extremely cheap. Price-earnings ratio of just 6, dividend yield of 3.5. So Sven, what's wrong with this? Why aren't you investing? And you see again here, it was really exuberant, but few investors made money over the long term by buying this behemoth of a company and powerhouse of European insurance. And this is again what I want to avoid when it comes to my portfolio. Yes, maybe you can gain something by playing around with these ups and downs, but that's really risky because of the downside. Now let's really discuss Aegon. So it's a big company, mostly in America and the Netherlands, so split across Europe and also the rest of the world. But let's just talk about the business. So they have new life sales, value of new life businesses, and this is all calculated by the actuaries that work with them, thinking about long-term trends based on some assumptions, and those assumptions, I cannot know whether those are correct or not, because not even they know. In the Netherlands, a lot of mortgages, I had the mortgage with them where they give you 100% of the value of the house, because in the Netherlands nothing can go ever wrong, and that's a huge risk they are taking. Of course, it's in euros, but the ECB will print euros as much as it is necessary, because home prices in euros cannot go down, because if not, the whole financial house of cards drops in Europe. And that's something we'll discuss next weekend, but it also shows the risk of investing in something like this. Then we have something like variable annuities to create value from this or that. So I'm not a specialist, but I have learned that when things get complex, it's better to run away. Net amount at risk, so 3 billion on a portfolio of 75 billion based on some assumptions. What if the assumptions change and this is suddenly 20 billion, like it is often the case with insurers. And then they have to manage down the variable annuity risk exposure because, of course, their assumptions when they were selling it were wrong, and they are engaging with external parties to weigh alternatives for de-risking it. So it's always something crazy with this insurance, and I prefer not to have it with me in my portfolio because, yes, now things are looking good, low impairments at zero interest rates, everything great, but what when the tide changes? It really gets crazy. Remember the stock price in the 90s, everything was great, and then boom, some impairments start arising and ooh, wow, it gets ugly. And you have here the main economic assumptions for their targets. So annual gross equity market return is US onwards 8%, onwards 6%, onwards 6.5%. What if it is 0% or it is a negative 10%? Then they are in deep insurance shit. So this might look cheap now or whatever, low P ratio, but this can go to zero. And let me tell you what Charlie Munger says about insurance companies and banks. Charlie Munger says that insurance companies go bankrupt usually every 3 decades. Last time big trouble with all the big insurers was the 1980s. Usually banks go bankrupt twice in a century. So we had 2009, when there was the savings and loan bankruptcies, 70s, 80s. So there is always really hard times for banks here or there. And there is always the business environment with banks and insurers. If there is a business that makes money, or it makes money or makes profit from an accounting, actuarial perspective, if you don't take that business, and if you take that business, you get your bonus and your fee, even if the company goes bankrupt 20 years down the road, then if you don't take the business, somebody else will. So there is always these books. And what is the risk that is accumulated in these books? That's something that we as investors cannot understand. Warren Buffett can, but he has also an itsy-bitsy tiny advantage that me and you, except for you, Warren, that I know you're watching. Thanks for watching and smashing that like button, Warren. I know you're old, but don't forget to smash that like button. There is something that Warren knows he has that we don't have, and that is money. That is billions, and that is an investment strategy that if a bank goes into trouble, he picks up the phone, he says, okay, I'll back you up, you will give me preferred shares with an 8% interest rate, and then I can convert it when things get better again. If you need more money, just call me and I will make billions on you easy. Goldman Sachs 2008, same thing with Bank of America. He just made a quick 12 billion. So this is Warren Buffett investing in banks, my friends. And yes, now times have changed. Banks are well capitalized because the Fed is printing blah 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 blah. We cannot know that from a retail perspective. Warren Buffett has been a specialist for banks for ages, but he is Warren Buffett because of that. I will not dedicate my life to just investing in insurance in banks, so I preferred avoiding it. And I don't have 100 billion sitting in cash to save my insurance empire if necessary, or not to see it go bankrupt when the hard times come. And those will come, and all the other insurers will go bankrupt when Warren Buffett will be buying them at 10-20 cents on the dollar. That's Warren Buffett. I'm not Warren Buffett, and therefore I'm not investing in banks and insurance. If you can understand everything and what's behind the books with all these financial institutions, then you're already owning a bank, probably already very rich, and you know how the business goes. So again, you don't need to invest in their stocks. Thanks for watching. I'll see you in the next video.